Welcome back to another stock analysis, where I look at some key metrics to calculate the fair value and my buy price for the stock. Today I'm going to analyze PepsiCo. Last, they generated a revenue of $80 billion. They have a market capitalization of $227 billion, and they are a food and beverages company. The revenue can also be divided into these two categories, where food contributes with 55% and beverages with 45%. This is only a rough division of the revenue, and it can actually be divided more precisely, where 32% comes from beverages in North America, and some of the most known brands are Pepsi, 7-Up, and Mountain Dew. Next comes snacks from North America with 26%. Here you for sure know some brands as well, such as Lay's, Doritos, or Cheetos. Unfortunately, PepsiCo don't separate the revenue outside of North America. Therefore, the following categories include both food and beverages. The region that makes the most revenue apart from North America is Europe with 17%, followed by Latin America with 10%, collectively Africa, Middle East and South Asia with 6%, Asia Pacific, Australia, New Zealand and the China region with 5%, and last we go back to North America, where quarter foods make the last 4%. As seen, PepsiCo is very diversified and also present in the emerging markets. Now I'm going to determine how much I should pay for the stock. The key matrix I use to calculate the fair value and buy price for PepsiCo is the dividend yield. I'll start with plotting the dividend yield for the last few years in a historical chart. I choose the dividend yield because a consistent dividend politic for me is the best indicator for a stable company. Additionally, a steady dividend payout helps to stabilize my portfolio and it makes it easier to rebalance my positions. To create some sort of signal line, I take the 5 years moving average of the dividend yield and plot it in the chart. The simple approach is now that the stock seems overvalued when it's under the moving average and undervalued when it's over it. The average of the last 5 years is 2.78%, and I would like to define this as the historical dividend yield. Since the historical yield is the fundament for my fair value and buy price calculation, this value shouldn't be too volatile. In an ideal case, the curve will give a straight line, and I can measure how much the curve deviates from this ideal straight line by calculating the relative standard deviation, which for PepsiCo is 2.4%. To the historical yield, I add a personal defined margin of safety of 25%. This margin of safety will be adjusted upwards or downwards depending on the matrix of the company. My first criteria is the stability of the dividend measured with the relative standard deviation. With this value, I can measure how volatile the dividend yield is. A high relative standard deviation will higher my risk to invest at a bad timing. As said earlier, the relative standard deviation for PepsiCo is 2.4%. This value is inside the green section of my weighting scale, and therefore I subtract 5% from the margin of safety. As a dividend investor, the dividend growth of course is very important to me. In 2007, $1.43 were paid, and in 2022, $4.52 is expected. PepsiCo has paid and increased the dividend for 50 consecutive years, which makes them a dividend king. In the last 5 years, the average dividend growth was 7.4%, and that's just inside the green section of my weighting scale. Therefore, I subtract 5% of safety for the dividend growth. By looking at the payout ratio, I'll find out if this dividend growth is sustainable for the company. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company is available after they've paid all necessary expenses. The free cash flow from PepsiCo increased from $5.42 billion in 2019 to $6.99 billion in the last 12 months. The cash dividend were respectively $5.3 billion and $5.87 billion. The average payout ratio is therefore 88%. This value is inside the red section of a rating scale, therefore I'll add 10% to the marginal safety. Next, I'll take a look at the debt situation. The company has a debt of $40.8 billion and has $6 billion in cash. When the cash gets subtracted from the debt, and this value then gets divided by the EBITDA, the debt to equity ratio is found. The EBITDA is currently at $14.12 billion. This leads to a debt to equity ratio of 246%. This means it will take the company just under 3 years to pay off the debt if the whole EBITDA were used for debt settlement. For this value, the margin of safety doesn't change. The last thing I'm looking at is the growth of the company. The revenue has increased from $63.53 billion in 2017 to almost $80 billion in 2021. This gives an average growth of 5.8%. In the same period of time, the EBIT increased from $10.79 billion to $11.41 billion, which gives an average growth of 1.4%. The margin is found by dividing the EBIT with the revenue, which in 2017 gives 17%, and in 2021 decreased to 14.36%. Since the revenue increased at a higher rate than the EBIT, it only makes sense that the profitability of the company decreases. For PepsiCo, it decreases with 4.1% in average each year. An EBIT growth of 1.4% is in the yellow section of my rating scale, which gives no adjustment. A decrease in margin, on the other hand, is not a good sign. And for an average decreasement of 4.1%, I'll add 10% to the margin of safety. Since every matrix for my analysis has now been collected, it is time to adjust the margin of safety. Minus 5% for the relative standard deviation, minus 5% for the dividend growth, plus 10% for the payout ratio, and plus 10% for the margin growth. The new margin of safety is therefore 35%. This leads to a desired dividend yield of 3.75%. By a current dividend of $4.52, I should therefore don't pay more than $113 for the stock. By ignoring the margin of safety, the fair price of the stock is determined, which for PepsiCo is $153. These values can also be shown graphically in the chart for the historical dividend yield. This is done by adding the margin of safety to the historical yield curve. This then gives a new curve which always lies 35% over the historical yield curve. As seen in the graph, the historical yield line and the margin of safety are over the yield curve. Therefore, I consider the stock as overvalued. Finally, I consider the stock at its fair value when the price is $153. I will buy the stock at $113, and the stock price is currently at $164. If you did like the stock analysis, please consider to give the video a like, let me know in the comments which stock you would like to see next, and subscribe to my channel for weekly content.